Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, hello everyone, and welcome to this month's edition of our AWA Market Minute. Scott, we're excited to be here with all of our clients, and as we approach the end of 2024, we thought a lot about how we wanted to approach today's Market Minute. We typically have segments that we kind of go through, but we wanted to do something a little bit unique today, a little bit different. And where this came from was Scott and I sat with our advisory team over the last few weeks and talked a lot about what were some of the recurring themes that came up a lot this year as we worked with all of our clients on their retirement plans and investment advice and wealth management strategies. And there were a number of themes that our advisors indicated came up over and over and over again. And so we asked them to kind of pool those together. Scott and I reviewed everything and noticed 5 kind of prominent questions and themes that were really important to our clients. And so we thought, as we get to the end of 2024, let's review these 5. Let's talk through them together as a group, Scott and I, and see if we can help shed additional light and insight into these 5 questions that I think are on most people's minds as we kind of wrap up 2024 and step into 2025. So with that context, Scott, I'm going to kind of go through some questions and see if you can help us kind of talk through these together. The first question that is on a lot of our clients' minds is the conversation on tariffs. We had President Trump campaign for most of the year on this idea that he was going to implement broad tariffs. And what would be some of the implications now that he's won the election of broad tariff implementation?
Yeah, no, great question that our clients have been raising, and excited to spend a little bit of time speaking about it today. So, tariffs are interesting. If you look at classical economic theory, tariffs typically are inflationary in nature, and tariffs typically result in kind of suboptimal allocation of production. So, for example, the U.S. might be more adept at producing higher cost, higher importance goods and services, and then those that are like maybe lower cost and easier use of production are better produced, elsewhere. And the global economic system has largely been built on that premise. Now that classical economic theory doesn't account for things like unfair trade practices or national security risks. And so there is perhaps, an argument to be made for some, targeted tariffs under the auspices of that.
Has that been done before? Historically, have we seen tariffs almost used as like to combat like illegal immigration and the drug trafficking concerns? Have we seen presidents say, "Hey, we're going to tariff this country if they don't behave the way we want them to behave"?
Yeah, I think tariffs. I think you could point to historical instances where tariffs have been used as a cudgel to get other things across the line, and that's the $100,000 question right now. Is the tariffs Trump is talking about? Are those a negotiating ploy to, bring about other things or bring our trading partners to the table or address other geopolitical risks, or are they going to be implemented as advertised, 25% across the board? And that the jury's still out on that. To the extent they get implemented as advertised, 25% across the board, that is potentially inflationary in nature. Because if you think about it, it's fairly intuitive. If the supply of goods is diminished as a result of tariffs, there's scarcity, and that pushes up prices. If more goods are produced domestically, it's more costly to produce those goods here in the U.S. That potentially is inflationary as well. But again, there's, it's speculative at this point because we don't know how that's going to play out. The president does have broad authority to enact tariffs, primarily for national security reasons or unfair trade practices. Beyond that, Congress, needs to theoretically get involved to some degree. But the Republicans control both the Senate and the House, so there's potentially a path there. So will be interesting to see how that plays out in 2025, and that will be something that we're watching very closely.
Well, one study from the National Retail Federation estimated that a tariff could reduce American spending power by between 46 billion and 78 billion annually. And that would be like that universal tariff that you talked about if that were broadly implemented. And then we see other versions of this, like the ones that he's threatening to impose on China, which were as high as 60% tariffs against China. One article talked about a new model that we're fearful would be emerging. And this kind of developed during COVID, where we saw supply chain shortages and as a result, increased costs to manufacturers and ultimately retailers. And historically, how that played out was, the manufacturers and retailers would kind of take the increased costs on their bottom line. But what they did during COVID was really fascinating. They passed those costs back to the end user, to the consumer, to us, and we paid them. And so I reading an article in the Wall Street Journal on this talked through this idea that we've developed this new potential habit or pattern of behavior where retailers are aware of the fact that consumers are willing to pay those increased costs where they have not kind of tested those waters in the past. So is that inflationary outcome? Would that be inflationary for us?
Yeah, I mean, I think there's strong potential there. And to your point, Paul, they made kind of tentative attempts at raising the price and then saw that those were palatable. And then it was almost how far can we go with this, right? And you go out to eat, and this is very evident, right? Where, you used to have heartburn over paying X for a good lunch, and now it's double that, and you don't bat an eye.
Yeah. You're going to go to lunch anywhere today, and it's $20, and that could be for a hamburger and French fries.
Yeah, no, absolutely right. One parting thought on that topic, Paul. The tariffs discussion is very, very nuanced. There's certain things to consider too, where certain countries subsidize industry very heavily. You look at like the EV industry in China in particular, and they can produce an EV for far cheaper than we can, and they have high battery life and everything else. And that's a result of huge government subsidies going into that. We've had some of that in the U.S., but not nearly to the same degree. So if they were to dump those cars in the U.S., that would be potentially catastrophic for domestic manufacture.
Yeah. So trying to incentivize people to bring manufacturing and keep manufacturing here is one of the potential, rationales for tariffs. And that makes sense. One thing I thought was somewhat interesting is I looked at, how often do presidents govern based on the way they've campaigned, and there tends to be a little bit of slippage, I'll call it, between kind of campaign promises versus the actual implementation of what they've said. Have you studied any of that?
Not a ton,
Okay.
A little bit.
It's interesting. So based on kind of PolitiFact, there are studies done from campaign promises made from the last several presidents versus how often they've followed through on that. And it tends to be a similar theme. It looks like about, half of their campaign promises tend to get enacted correctly. And then maybe as much as, 20 to 25% kind of get partially implemented. But it's pretty well recognized that not every campaign promise will be fully implemented to the extent when they get to govern. And that brings us to another kind of common theme that was playing out amongst our clients this year, and that's how much control does the commander-in-chief actually have over our economy?
Yeah, and I think this is something that's, and I'll use the term grossly overstated. I think, we do not, have a centrally planned economy, and the genius and the beauty of the U.S. system is decentralized command, right? Where you have individual economic participants making big economic decisions, and the collective effect of that is economic growth, where the U.S. leads the world by a country mile. And so, yes, the administration can have impact on incentives through things like tax policy, regulation, etc. But as far as the ability to really tighten the screws on the economy and do things that are really ruinous, yes, there's some potential there, but you can point to data over several decades where, regardless of who's in the White House, economies have done well, they've done poorly, they've been somewhere in between. So there's a lot less power vested in the executive branch to affect the economy than maybe what is broadly thought.
And we pointed this out in a couple of our episodes earlier on, where I think a lot of people were worried about the outcome of the election, and for both sides had expressed some concern about that, and we pointed out that, just like you said there, Scott, historically the economy doesn't have some kind of significant response to either party winning the White House. It has more to do with the overall composition of government, and how we have a divided government. That tends to be good for the economy as far as not having too much power or too much control. And that says nothing about, if the president is enacting executive order. In other words, if what they want to accomplish can be accomplished via executive order, they have a much smoother path to action there. If there's congressional dynamics involved, it can really grind some of those ambitions out. There's not a lot of ability to make change if you have to go through Congress. There's also, natural disasters and events that they have no control over. A pandemic, for example, those kind of external crises can impact our economy, and the president will have very little control over that.
Yeah, and I think with the U.S. system too, there's this self-correcting mechanism where one party will have power for an extended period, then the pendulum swings significantly the other way, and it is a little bit of a whiplash for the electorate, to be sure, but the outcome of that is you avoid long-term policy extremes. You might have policy extremes over a short period of time, but then there's a changing of the guard. Now, if our system had one party in power in perpetuity,
then we'd be Russia.
Yeah, you could see more like encroachment of the government on private enterprise or whatever, but because of the changing of the guard with some frequency, that doesn't happen.
Yeah, and that's one of the beauties of our current system. So let's switch gears, Scott. Another question that we got regularly pulled from our advisors as they kind of talked through the 2024 year with their clients was on diversification. It gets brought up in almost every meeting. In a year like 2024, where frankly the S&P outperformed a well-diversified portfolio, our advisors said this: I find myself explaining why we remain committed to diversification and how that will benefit our clients in the long run. You want to talk a little bit about that?
Yeah, no, it's a fascinating topic, and when you have broadly rising markets, and particularly a market like we've seen in 2024, where a handful of companies are driving a lot of the returns, the temptation there is to fall into poor habits, right? When things are relatively easy, it's easy to get sloppy with things. But then when there's a course reversal, people get exposed or strategies get exposed. And if you look at a diversified portfolio, those who had diversified portfolios in 2008 weathered the storm far, far better than those who didn't. And you can point to almost any data point over history when we've had market drawdowns, and diversified portfolios have fared extremely well. And this becomes much more important during retirement. As one is accumulating one's wealth, yes, you want diversification, but because you're not withdrawing funds at that juncture, it's not as important. And that's not to say it isn't, because it certainly is. But once you're retired, diversification is indispensable, because we don't know what the future is going to bring. When conviction is relatively low, diversification needs to be high, and we live in a time where there's high geopolitical risk. We live in a time of huge technological innovation. We live in a time of huge demographic shifts, and all of those things are somewhat uncharted waters, and the more uncertainty there is out there, the more benefit diversification is in the long run.
And I think it's really interesting, Scott. We're talking about a diversified portfolio versus the S&P. I think a lot of people have this perhaps erroneous concept of the S&P being a well-diversified benchmark. The idea there is I've got 500 stocks that are broadly representing what we'd call the market. And so therefore that is a well-diversified fund. And as I explain this concept to people, I see people go, wait, what? I didn't understand that. So let me explain it here at the risk of being very, very juvenile. So the S&P, yes, is made up of 500 stocks, but the weighting is not, there's not like every stock doesn't represent 0.2% of 100% of the S&P. There's not 500 stocks that are equally weighted across that benchmark. What you end up with is every stock is represented of those 500 in the S&P based on their market capitalization. And so when you look at the S&P in the sense of how its market capitalization will determine the balance and the weighting of each of those 500 stocks, you've got some stocks in there that have virtually no impact on the overall performance of the S&P because their market capitalization is so small relative to some of the big hitters. So these big hitters we now call the Magnificent Seven. There you've got Apple, Microsoft, Alphabet, Amazon, Meta, Tesla, and NVIDIA. And these 7 stocks surprisingly account for well over a third of the weighting of the entire S&P 500. So fathom that. So a third of the entire weight of the S&P is 7 stocks. So 493 are taking on the other 2/3. But what's really crazy is the performance attributed to the S&Ps from these 7 stocks in 2023 was 2/3 of the entire performance was 7 stocks. In 2024, halfway through the year, they haven't finished 2024 yet, so we don't know what it'll end up being. But through the first half of the year, was over half of the performance of the entire S&P was attributed to these 7 stocks. So if I own the S&P thinking I've got a broadly diversified portfolio, I am wrong. And when I look at the performance of the S&P and I think, gosh, I did really, really well, that's not because the S&P as a whole performed well. It's in fact, I can almost directly point to those 7 stocks and say, those have carried the water for me. That becomes problematic when we talk about diversification.
Yeah, absolutely, Paul. And as you were kind of walking us through that, a case study, that is brought to mind is that of NVIDIA, right? So a year ago to, the layperson, NVIDIA wasn't even on their radar. Today, NVIDIA is worth, on paper, $3+ trillion.
Right.
Trillion with a T.
Right.
And for perspective, US GDP is, knocking on the door of 30 trillion. So we're saying one company that wasn't on people's radar, a year or so ago is now 10% of US GDP. That doesn't quite pass the sniff test.
No.
There's some assumptions embedded in there with AI and other things, and maybe they will materialize. AI does have the potential to be transformational, but the price embedded in there suggests just gangbusters growth in AI in perpetuity.
And so let's talk application to clients here. This is why we're having these conversations. When we review a portfolio, we look at like someone's 401k from their employer. It's not uncommon to see 5 or 6 or 10 different versions of the S&P 500 in their portfolio, right? Some S&P 500, proxy. Sometimes they'll have the S&P 500, and they'll have some large cap or some core stuff, and you're like, this is really kind of like the S&P in redundancy over and over again. And so when I have a portfolio that just has kind of all those same holdings and they're all pulled from the same market capitalization, I end up with NVIDIA representing this way outweighted balance or portion of my portfolio. And when we're talking about you are now in retirement, when we see market drawdowns, who do you think is going to take it first, right? When NVIDIA has the ability to represent, over an 18-month period of time, move from zero to hero some of those companies have some of the bigger exposures on the whiplash backside. And so when we talk about people in retirement and our advisors are telling our clients diversification, 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 please understand why. We practice best practices and teach fiduciary principles so that our clients can maintain their standard of living and their peace of mind into and throughout the retirement years. And when we get caught up in the idea of chasing the hot dot and looking at the S&P performance for 2024 and saying, look how well it did, I want to chase that. There's a reason. Scott and I aren't stupid. And if we just wanted to chase the hot dot, we could do that too. Our advisory team here at Alliance Wealth, they understand these concepts. If we wanted to chase the hot dot, we could do that too. There's a reason we've maintained conviction during 2024. And consider this, there's a reason you've hired us during turbulent times, and that is to help you understand following conviction and principles in retirement is always your best path to security in retirement. So with that, I think that's a good way to leverage our next conversation or segue into our next conversation. And another conversation that gets brought up all the time, Scott, our advisors all reported back, crypto FOMO. And for those of you who don't know what FOMO means, it means fear of missing out. And we get people all the time saying, well, goodness gracious, why haven't you given me any opportunity for crypto?
Yeah. No, and to your point, Paul, this is something that occupies headlines, and you read stories of overnight millionaires investing in crypto, and in popular culture, discussion of crypto is ubiquitous. So, to Paul's earlier point, at the risk of, being too, maybe elementary, I do think it'd be helpful to kind of, set the groundwork as far as what cryptocurrency is. And so cryptocurrency is a medium of exchange. So think about a US dollar or a euro, or whatever unit of currency. It is a medium of exchange. And it's also what's called a fiat currency. It's not backed by anything, so it's based solely on trust. But crypto is unique in the sense that it's based on something called blockchain technology, and blockchain technology uses high levels of encryption and other sophisticated techniques to ensure there is an immutable and unchangeable sequence of ownership. So the record of ownership with any of these cryptocurrencies is immutable, and there's security in that, based on that blockchain technology. But blockchain is not cryptocurrency. Cryptocurrency uses blockchain technology. Blockchain technology may have use in financial records, medical records, etc. And there's some exciting opportunities there. But crypto is not going to be reflective of that. So it's important to make that distinction.
And yeah, I love that. Two separate utilizations and purposes, and where you hear people talk about the future of blockchain and what opportunities lie there. Don't muddy the water and say that is crypto. It's not. They're two different things.
Yeah, it's not like you can buy, Bitcoin, and to the extent blockchain explodes in other industries, you are the beneficiary of
Correct.
that. So I think that's an important distinction. But at the end of the day, it is a medium of exchange, full stop. And so, if someone were to come up to me and said, hey, what are you investing in, Scott? I'm investing in dollars. They'd say, well, no, but what's the actual investment? Is it a stock? Is it a bond? Is it a mutual fund? Is it a CD? And I'd say, no, I'm investing in dollars. And they'd say, well, a dollar isn't an investment. A dollar is a medium of exchange. And that's the case with cryptocurrency. But there's been this euphoria around this new technology and the potential for it to kind of revolutionize how we do business with one another. And that has driven the price through the roof. But at the end of the day, some of the benefits of crypto, and I don't know if they're necessarily all benefits, but the secrecy, the privacy, et cetera, that's associated to crypto, that could be done with the sweep of a pen via legislative order, and you would see a precipitous drop. And so I think the brass tacks and thing to consider here, this is a highly speculative enterprise, and people can make a lot of money on speculation. There's no two ways about that. But for most retirees, this is a arena that doesn't make it a lot of sense to invest a lot of time in.
And we get people that will say, hey, I've taken a portion of money, and not a lot, right? They'll call it their mad money or their risk capital. It's just kind of stuff that they do for fun, and they'll throw it in crypto, and they'll come back at the end of the year and they'll say, look, I made 150% return on this really wild crypto that I purchased earlier in the year. And that's real. That's actual dollars. And so it's hard to argue with somebody who comes to you and says, look, it's real money. I actually made money. You can't argue with that. It's real money. And the problem is, how we always operate are based on best practices and fiduciary principles. Crypto, what is the asset that the underlying asset that you own? What backs that thing is nothing. Like Scott mentioned, it's fiat currency. And so you don't own an asset. There's a speculation that will drive its value, and right now with the emotions of what's kind of happening in investing, it continues to drive that value up because more people want to jump in the game, and that will drive pricing. But what is underneath that, it's not like we can evaluate it like we can understanding the benefit of McDonald's, saying, okay, I can see what the revenue that's being generated by it is. I can see the real estate holdings. I can look at the market share that they own, and I can put a value on owning a share of that enterprise. Cryptocurrency doesn't have any of that. It's completely based on, if I buy it today at X, I'm hoping tomorrow that somebody else is going to be willing to buy it at X plus in order for me to make money on this. And to your point, Scott, the allure of crypto today, I think, is this deregulation, this notion that there's like, I can do this without having a bunch of oversight. And if this is ever going to get legs, it's going to, if a government is ever going to say, hey, this is going to become a form of how we actually use currency, there will, make no mistake, there will be sweeping regulations imposed on crypto. And then the allure of this thing kind of vanishes.
Yeah, and it kind of reminds me, if you've watched any old like spy movies, they talk about bearer bonds, pay me out in bearer bonds. And what bearer bonds were, they were U.S. Treasury bonds, and whoever held said bond physically was entitled to the payment, no questions asked, and so it provided for some anonymity. There aren't bearer bonds anymore.
No.
And so those were cracked down on as far as like new issuance. There's not any of that out there. And so you very well could see regulation come down the pike in the future. And you could also see competition from sovereign actors. China's been dabbling in digital currency, and others might as well. So it'll be interesting to see how this evolves. But I think our word to our clients would be, to be very, very cautious in that particular space.
And maybe one more time emphasizing the point. If we felt crypto was a good investment, our firm could have our clients use crypto. So don't make the mistake of saying, well, because AWA doesn't promote crypto, that means they don't have access to. Or Scott and I, our firm are fiduciaries. We're not beholden to any particular investment. We just follow very real principles, and we stay convicted to those principles, and that's how we will always promote a retirement portfolio. And so when things kind of become the hot dot and exciting and sexy for a minute, we have to take a position against that, not because we're saying, hey, it doesn't promote us to have those. It's saying we're representing our clients' interests, even when the emotion and the prevailing wisdom of the moment tells you otherwise. That's why you hire us, is to tell you, hey, this might not be the best long-term play. So let's switch gears. We just have a couple minutes left, Scott. Real briefly, one of the conversations that played out a lot this year was on Roth conversions. With the outcome of the presidential election, are they still important and urgent?
Yeah, so I think important, yes. Maybe the urgency has gone down a little bit. So the Trump tax cuts of 2017 were not forecast, they were going to sunset at the end of 2025. There's a strong likelihood that they may be renewed in some way, shape, or form. And if so, there's not quite as much urgency to get in under the gun in 2025. In terms of like long-term, though, with the high levels of debt, with the demographic trends that we see, there's still a lot of appeal with Roth conversions, but maybe a little bit less urgent.
Yeah, and I like how you frame that. I think Roth conversions are still always part of a potential planning tool. And when we're $35 trillion in national debt, someone's going to have to pay that back. But the urgency that we were feeling, a lot of our clients express urgency due to the pending presidential election, and then also the potential for the Trump tax cuts to expire in 2026. Some of that urgency might have subsided. Doesn't mean we shouldn't look at Roth conversions as a planning tool, but it just means that we can maybe approach that with a little more, we can be a little more planning centric and a little less emotional around that decision. So, all right, the last thing, and we just have a minute is all, but this was one that I feel like needs to be touched on. And the premise to this was, years ago, took my family down to St. George, and we were out on one of these red rock hikes. And as we were making our way around, my oldest at the time, she was probably 12 or 13. She kind of gone out ahead of us a little bit. And I turned the corner to kind of catch up with her. And I found her clear up perched on top of the face of what would be a pretty steep kind of rock face. And she was perched on the very, very top of this thing. And I mean, this thing was probably, I don't know, something like 60 degree grade. And she had, kind of walked up it like a ladder, kind of kept going up like a ladder. And when I turned the corner, she was crying up on top of this thing because she couldn't figure out how to get back down. And it was terrifying because she was up there a good 50 feet. And I had to, make my way up there and help her figure out how to get back down. She could negotiate the up, no problem, but negotiating the down was terrifying. And rightfully so. I mean, if she had made a mistake, she could have come down and she definitely would have been in a very bad spot falling down the face of this cliff. The idea here is when we go through the accumulation phase, and Scott, you mentioned this earlier, kind of some of the principles that we adhere to maybe are a little different. It's a lot easier to go up in our investing than it is to come back down. When we are on the way back down of our investing, we can expose ourselves and it becomes much more difficult. And so one of the themes that played out this year quite a bit was the idea that, some of the traditional methods for building a portfolio really were exposed. In 2022 and 2023, we saw, the idea that I put a portion of my money in bond funds, and that kind of represents a volatility buffer that will help my portfolio during periods of time where markets become very unstable. That portion can kind of create that stability for my portfolio in the decumulation phase of retirement. And that was totally exposed and debunked in 2022 and 2023 with the interest rate movements. We saw long-term U.S. Treasuries drop as much intra-year in 2022 as 35%. So that kind of exposure is every bit as significant as the S&P 500 exposure would have been. And all of a sudden, we debunk this concept. So Scott, what are some of the themes that we wanted to teach and make sure that our clients follow going forward in their retirement plans?
Yeah, I think a key takeaway from that is each drawdown looks a little bit different. The things that fared well in the previous drawdown might not fare well in the next one, and that really speaks to the diversification principle that we spoke to earlier. In contrast, 2008, bonds saved people's portfolios, whereas 2022, that wasn't necessarily the case. And so because we don't know exactly what the next drawdown will look like, nor when it will happen, we always need to be ready and we always need to be prepared. And the principles that we employ with our client portfolios really try to address that.
Smart withdrawals, you guys. And if you get nothing else out of today's Market Minute, it's just know that your portfolios here are utilizing smart withdrawal principles, which means we employ a bucket concept with gray money, green money, yellow money, and red money. And the idea of having smart withdrawals means that regardless of different, movements in the market, we have the ability to access portions of your portfolio for distribution planning purposes without exposing the other portions of our portfolio to significant loss due to mistiming our withdrawals against a volatile market. This becomes probably the most significant benefit to our retired clients of any other thing that we teach and do for our clients. Smart withdrawals will help a client maintain their portfolio, keep it intact during periods of economic uncertainty and volatility, and allow you the peace of mind you deserve in retirement. And this was a common theme that came up over and over again during the 2022 and 23 and 24 years, was how do I ensure that I can access my money even during periods of economic uncertainty? Smart withdrawals. So, Scott, we're a little over on our time. For all of our clients who joined us today, we really appreciate it. 2024 was a unique year. We learned a lot, and we had a lot of these conversations over and over and over again. And we look forward to 2025 with, I would say, some degree of optimism. And we'll probably kick off our 2025 Market Minute with some of those conversations as well. So to everyone with us today, thanks so much, and enjoy your Merry Christmas.
Thanks.